Most people believe wars destroy wealth, but history shows something very different. The biggest fortunes are often built during chaos, not after it. And right now we are entering one of those rare moments where fear is everywhere, but clarity is extremely limited. Institutions are not reacting emotionally. They are positioning quietly because they understand one simple truth. Markets do not reward the obvious. They reward the prepared. While retail investors are focused on headlines, smart money is focused on what comes next, not what is happening now. This is where the difference begins. Because the current situation is not just about conflict, it is about what that conflict triggers inside the financial system. And that trigger is far more powerful than the event itself.
At this moment, most people are either panicking or doing nothing. Both responses feel safe, but both are historically wrong because markets move in cycles, and every cycle has a turning point. That moment does not come when everything looks good. It comes when everything feels uncertain. Oil prices are rising, volatility is high, and confidence is falling. But beneath all of this, something subtle is shifting. The bond market is starting to behave differently, and this is not random, because bonds often move before everything else. They reflect what large institutions believe is coming next, not what is happening now. And right now, they are signaling a change. Here is where things get interesting. When oil rises, normally inflation fear increases and markets struggle. But when the system starts fearing slowdown more than inflation, the entire narrative flips. Suddenly, the focus shifts from controlling prices to supporting growth. And that is when central banks begin preparing to act, not loudly, but gradually. Liquidity expectations return, rate cuts enter the conversation, and financial conditions begin to ease, even before any official announcement is made. This silent transition is what creates opportunity, because most people are still reacting to the past, while the market is already pricing the future. Now think about what this means in simple terms. When fear reaches its peak, assets are often priced far below their actual long-term value, not because they are broken, but because people are emotional. This creates a gap between perception and reality, and that gap is where money is made. The key is not chasing what has already moved. It is identifying what has been unfairly pushed down. Strong businesses, stable sectors, and long-term trends that are temporarily ignored. These are the areas that tend to recover the fastest once stability returns. And that recovery is rarely slow. It is usually sharp and unexpected. There is a pattern that repeats in almost every crisis. The first phase is panic, the second phase is confusion, and the third phase is repositioning. Most people get stuck in the first two phases, but wealth is created in the third phase, when positioning happens before clarity becomes obvious. This requires patience and awareness, not prediction, because the goal is not to perfectly time the bottom. The goal is to be present before the shift begins. And that shift is often triggered by policy changes, liquidity injections, or even small signals of stability that the majority tends to ignore until it is too late. So the real question is not whether uncertainty will continue. It probably will. The real question is whether you understand what comes after uncertainty, because that is where the advantage lies. The investors who succeed in these moments are not the smartest or the fastest. They are the ones who remain calm, while others react emotionally. They observe signals instead of headlines. They focus on structure instead of noise. And most importantly, they prepare before confirmation arrives. Because by the time everything feels safe, the opportunity is already gone. Every major disruption in history has followed the same pattern. Fear creates distance between price and value, and that distance eventually closes. The only difference is who is ready when it happens, because when the shift comes, it does not wait. It moves fast and rewards those who understood the process before it became obvious. Now let us go deeper into what actually separates smart money from the crowd, because this is where most people fail. They think success comes from predicting the future, but in reality, it comes from understanding behavior. Markets are driven by human reactions, fear, greed, and uncertainty, and during crisis, these emotions become extreme. This is why prices disconnect from reality. Strong assets get sold, not because they are weak, but because people need liquidity. And weak assets sometimes hold longer than they should because people refuse to accept loss. This imbalance creates opportunity, but only for those who can stay rational while others are emotional. Think about this for a moment. When everyone is looking in the same direction, they are usually looking at the past, not the future. Headlines focus on what already happened. Price movements reflect what people have already reacted to, but the real opportunity lies in what has not yet been fully understood. This is why institutions spend so much time analyzing second-order effects, not just the event itself, but what the event triggers. For example, rising oil is obvious, but what it does to policy, what it does to liquidity, and what it does to investor behavior, that is where the real game is played. Another important concept most people ignore is time horizon. Retail investors think in days or weeks. Institutions think in months or years. This difference alone creates a massive advantage because short-term fear often hides long-term opportunity. When markets drop quickly, people assume something is broken, but in many cases, nothing fundamental has changed, only sentiment has shifted, and sentiment can reverse much faster than fundamentals. This is why the biggest moves often happen when the majority is still uncertain, because the market does not wait for everyone to feel comfortable before it moves higher. Now consider how capital actually flows during these moments. Money does not disappear. It moves from one place to another, from weak hands to strong hands, from panic sellers to patient buyers, from overvalued assets to undervalued ones. This rotation is constant, and understanding it is critical, because if you are on the wrong side of that flow, you will feel like the market is against you. But if you align with it, you will see opportunities where others see risk. This is why following capital flow is far more important than following news, because news explains the past, but capital flow builds the future. There is also a psychological trap that appears in every crisis. People wait for certainty. They want confirmation before acting. They want proof that the worst is over. But by the time that proof appears, prices have already moved significantly higher. The market rewards anticipation, not reaction. This does not mean taking reckless risks. It means understanding probabilities and positioning accordingly. Even small, early decisions can create large outcomes over time because they allow you to capture the full move instead of chasing it halfway through. One more layer to understand is the role of liquidity. Liquidity is the fuel of financial markets. When liquidity is tight, markets struggle. When liquidity expands, markets rise. This is not opinion. It is observable across decades of data, and during crisis periods, liquidity conditions often change rapidly. Central banks, governments, and institutions all respond to stabilize the system, and those responses create new flows of capital into specific areas. This is why watching liquidity signals is one of the most powerful tools any investor can develop, because it shows where money is likely to go next. So what should you actually focus on right now? Focus on structure, not noise. Focus on long-term strength, not short-term fear. Identify assets that still have strong underlying demand, strong business models, and long-term relevance, but are temporarily affected by current sentiment. These are the areas that tend to recover first and strongest when conditions stabilize. At the same time, avoid chasing assets that have already moved significantly, because by the time something looks obvious, the majority of the move is usually already done. Patience and positioning matter more than speed. In the end, every crisis tells the same story. Fear creates opportunity, but only for those who understand the process. While most people react to what is visible, a small group prepares for what is coming, and that difference changes everything. The shift does not announce itself. It happens quietly and then suddenly. The only question is whether you are ready before it happens, or whether you will realize it after it is already over. Because by then, the opportunity is no longer opportunity, it is history. And here is something very few people truly understand. The biggest risk in markets is not volatility, it is hesitation. Because hesitation keeps you stuck between fear and action. You see the opportunity, but you do not move. You wait for one more signal, one more confirmation, one more moment of clarity. But markets do not reward hesitation. They reward conviction built on understanding. This is why the gap between knowing and doing is where most potential is lost. The investors who succeed are not fearless, they simply act. While uncertainty still exists, they accept that clarity comes later, not before. And that mindset alone separates those who participate in opportunity from those who only observe it from a distance. Now think about how information actually spreads in the market. It does not reach everyone at the same time. It moves in layers. First, institutions, then professionals, then the general public. By the time something becomes obvious to everyone, the advantage is already gone. This is why relying only on popular opinion is dangerous, because popular opinion is usually late, and reacting to it often means entering when the risk is highest and the reward is lowest. Understanding this delay gives you an edge, because it allows you to act before the crowd fully understands what is happening. Another critical factor is emotional discipline, because even if you understand the opportunity, executing it is not easy when prices are falling and headlines are negative. Every instinct tells you to stay away, but this is exactly when decisions matter the most. Discipline is not about ignoring risk. It is about seeing beyond immediate fear and focusing on long-term outcomes. The ability to stay calm in unstable conditions is one of the most valuable skills in investing, and it is also one of the rarest. Let us also talk about momentum, because markets do not just move based on value, they move based on perception, and once perception shifts, momentum follows. This is why recoveries often feel sudden. One moment everything looks weak, and the next moment prices are rising rapidly. This is not random. It is the result of positioning that happened earlier, when few people were paying attention. And once momentum begins, it attracts more capital, creating a cycle that pushes prices higher than most expect. At the same time, it is important to understand that not everything will recover equally. Some areas of the market will remain weak because their problems are structural, not temporary. This is why selective thinking is critical. Blindly following trends rarely works long-term. The focus should always be on quality, strength, and relevance, because in every cycle, the strongest assets not only recover, but often come out even stronger, while weaker ones fade away. There is also a deeper layer to all of this, which is trust. Markets are built on confidence. Confidence in systems, policies, and future stability. And during crisis, that confidence gets shaken, but it does not disappear. It shifts and eventually rebuilds. Once that rebuilding process starts, it creates a powerful foundation for recovery, because capital begins to flow back into the system, gradually at first, and then more aggressively as confidence returns. Another insight is that opportunity rarely feels comfortable. If something feels completely safe, it usually means the opportunity is already priced in. Real opportunity exists in moments of doubt, where outcomes are uncertain, but probabilities are favorable. This is where analysis matters more than emotion, because decisions made in these moments often define long-term results, and those who understand this do not wait for perfect conditions. They act when conditions are imperfect but promising. It is also worth remembering that every cycle creates new leaders. Industries evolve, technologies advance, and economic priorities shift. This means the next wave of growth may not look exactly like the previous one. Staying adaptable and open to change is essential, because rigid thinking can cause you to miss emerging trends that have the potential to shape the future in significant ways. So as you watch the market right now, instead of focusing only on what is falling, ask a different question. What is quietly building strength beneath the surface? What is being ignored? What is being undervalued? These questions shift your perspective from reaction to observation, and that shift alone can change how you see opportunity, because the market often hides its biggest moves in plain sight, but only for those who are looking in the right direction. In the end, the difference between those who grow wealth and those who miss it is not access or luck. It is awareness and action. The ability to understand what is happening beneath the surface and the willingness to act before it becomes obvious. Because when the shift finally becomes clear to everyone, the real move is already over, and the only thing left is the story of how it happened.